If you're a doctor, engineer, or some sort of high-paid professional, this video is for you. Now, I'm a big fan of short-term rental investing. I've said that a lot on this channel. And as good as it is, there's something about it that I really want to open your eyes about, because it's something that's really impactful, especially for those of you that are high-income earners. Now, before I dive in, I'm not a CPA. I don't play one on TV, but I'd like to explain to you what I've learned, because this is an approach that I've used and it's been very successful for me, and I think it can be very successful for you too. I went into my first short-term rental investment with this approach in mind, and it really helped a lot. But before taking action, please talk to your CPA to make sure this works for you as well. Now, I'm going to approach this in 3 steps. The first, I'm going to talk about active versus passive investing. Second, I'm going to talk about what's known as the short-term rental loophole. That is something that I've used, and this is really the foundation of what we're talking about. And third, I'm going to talk to you a bit about depreciation and what's known as cost segregation studies. Now, taxes may not be super interesting to a lot of people, but the fact of the matter is taxes are our biggest expense, especially if you're a high-income W-2 earner. So paying attention to this is important. To talk about active versus passive income, let me jump to an illustration for you. According to the IRS, there are 2 types of income. You've got active income and passive income. Active income is what you would think of if you're a doctor or an attorney or an engineer and you have a really good paying job. That is active income. That is work that you're actually putting active work into it and you're getting money in return. And that income, you can make some pretty good money being an active W-2 earner. But as you know, a large part of that goes into taxes. And so that's your biggest expense when you're a W-2 earner. Now let's talk about passive income. Passive income can be things like real estate. It could be stocks. It could be other things that aren't necessarily something that you're putting your physical work into that makes you money. Now, the IRS separates this out, and you can make some pretty good income with the passive route as well. And there's more tools available to be able to reduce your taxes when it comes to passive income. For example, you could actually end up paying less than you would in the active side through what's known as depreciation, which is something that I've talked a lot about in this channel. But the big point I want to make here is that depreciation and these tax strategies that can be used for real estate are typically not able to be used for active income. So if you're a high-paid individual and you want to reduce your W-2 taxes, you cannot use the depreciation and things that you're using for your passive income. There's a strict line right in the middle that the IRS draws. But I want to share with you now, which is my second point, is you can actually utilize depreciation for some of your passive income to reduce your taxes on your active income. Now, I just finished saying a second ago, they're very separate and you can't cross that line. How do you do this? And this is through something called the short-term rental loophole. And I'm going to explain that to you right now. Now, how can you use the tax benefits of rental real estate to reduce your W-2 taxes, your active income taxes? The short-term rental loophole, basically, the reason they call it a loophole is because according to the IRS, if you have a short-term rental and the average stay throughout a year is less than 7 days, then that's not considered passive income. It's considered active income. It's considered a business. And that's where the differentiator is. That's where the loophole is. It's almost like it's considered a hotel, for example. It's a business. And so you can utilize the tax benefits from that business to reduce your active income, which, if you're a highly paid professional, probably has a lot to do with your W-2. This is exciting because you can invest in a short-term rental, get a lot of depreciation built up, and apply that to your active income because you're renting it out for less than 7 days on average throughout a given year. Hey, real quick, are you liking this video? Please click the like button so YouTube knows that this video is worth sharing with other immigrants. Now back to the video. Now, one important note for this to apply is that you're actually what's called materially participating, which means you are an active manager of this property. Now, the IRS has a number of rules on what that means. Probably one of the most common ones is that you spend at least 100 hours of your time throughout a year, and over 50% of the time in that activity. And that's probably the easiest way to do it. In 100 hours in a year, that's what, like 2 hours a week? That's very doable. Okay, so now we know about active income and passive income, that they're both very separate. But in the situation of short-term rentals, which are rented less than on average 7 days in a year, then that is a business and that is considered active income. And all the benefits that go with that short-term rental will apply to your active income. The third thing I want to talk about is depreciation. So if you don't know, depreciation is just this IRS rule that basically says that you get to write off a certain amount every year because of the wear and tear of your property. For residential real estate, it's 27 and a half years. If you have a value of a home that's say $500,000 and say 100,000 of it is land, that leaves you $400,000. Divide that by 27 and a half years, and that's how much you can depreciate every single year. So that's known as depreciation. And that's something that'll reduce your tax bill. And you can do something called a cost segregation study. And what this is an engineer looks at your property and says, well, this much of the value of your property is things that depreciate within 5 years. This much of your property is within 7 years. This much of your property has assets that depreciate within 15 years. And this study is the way you can basically front load a lot of your depreciation up into the beginning years of your 27 and a half years. And back in 2017, Congress passed what's known as the Tax Cuts and Jobs Act. And it did a lot of things, but one of the things it did that really helped us when it comes to real estate investing, it allowed real estate investors to take that accelerated depreciation that you had identified through the cost segregation study and bringing up earlier to year one. Now, in 2022, 100% of that accelerated depreciation could be brought to year one. In 2023, it was 80%. In 2024, 60%, et cetera. And every year it's been decreasing. Now, that might change here in the future, but that's the way it is now. So imagine being able to pull up a lot of that depreciation up to year one. Now, what does that mean for you as a high income earner? Is that you get a huge depreciation benefit that can be applied towards your taxes on your W-2 income. So let me tell you how I use this. So back in 2022, I bought a log cabin as a short-term rental that sits on Lake Norman. And I was able to do a cost segregation study on that. And my average stay that year was less than 7 days. So that's considered an active business. I was able to depreciate it, do accelerated depreciation based on that cost segregation study. And then I was able to utilize 100% on year one, because there was a time when 100% of that accelerated depreciation could be brought up to year one. And so that's what happened. So I spent about $680,000 on that cabin, and about a third of it I could accelerate to year one. So I got a $200,000 benefit against my taxes, which drastically reduced my active income. I ended up saving $44,000 that year on taxes because of the strategy. Now, the way depreciation works is that it doesn't mean you don't ever pay taxes. It means that you're basically delaying the tax burden to a later date. When you go to sell the property after 5, 10, 15, 20 years, you're going to have to pay back what's known as depreciation recapture. Now, there's a strategy that you can follow to avoid having to do that, which is called a 1031 exchange, which I'll make a video about here in the future, because that's a really interesting concept too. So this is a strategy that I've just walked through, that if you're a highly paid professional and you have a W-2 and you make a lot of money, you probably pay a lot of taxes, and this can be a big benefit to you. Now, if you're wondering, okay, Dan, that's great, but I'm a little hazy about the tax benefits of real estate, then why don't you check out this video right here that'll explain it in good detail. Thanks for watching the Immigrant Wealth channel.